Hello, Vladimir Rybakov here, and welcome to my performance chart video. And in this video I will explain how to recognize professional traders by the performance you watch from them. So basically there are a lot of traps on performance chart, and many traders don't pay attention to the real numbers, to what's playing the most important role. So in this video I want to explain it exactly so you know what to pay attention to, so you are aware about performance chart myths, you understand the logic behind it, behind the performance chart, you get and learn to recognize the warning signs, and I will show you and explain the reality versus the myths. So let's start. As I said, my name is Vladimir Rybakov. For those of you who don't know me, I'm the owner of Forex Signals and Mentoring Club on my name. I run it for several years now with very big success, and you can find all the details right on the bottom of the presentation. So let's see what we have here. Well, a long time ago my chart also used to look like that, and there's nothing wrong here, but there are several things to understand and to pay attention to. Okay? The equity line does not go hand in hand with the growth line, which means there are several opportunities there are several options. Basically, one of them is no fixed stop loss. There is just a number of or trade without stop loss, or have an exit idea from a trade, which is not problematic at all, as long as you know what you are doing, as long as you have a clear plan. There is nothing wrong to trade without stop loss, as long as you know exactly how you are going to manage your trade, and of course as long as your pockets are able to pay for that, right? So if you have $300 account and you have 0.1 position, every pip is $1. Well, 300 pips move against you and you blow your account. So there is no logic behind that, right? So as long as you know your clear plan and you know the risk management you do, there is nothing wrong with this kind of view. Okay, big losses compared to the consistently small profits. You can pay attention to the dots. Okay, most of the trades have big stop losses, like here on this drop. The stop losses are big in case the trader uses that, or maybe it's not stop loss, maybe just exit plan, but compared to the profits, they are pretty big. Most of the trades, again, not all, because here it's pretty different, but here most of the trades are very, very close to each other. The growth is small compared to the drops we have. Not everywhere, most of it. So basically there's nothing wrong with this chart. It's growing, and it's growing well. The gain is 80 plus, almost 90% gain versus 28% drawdown. It's almost, it's 1 to 3, around 1 to 3 ratio. Nothing wrong with that. Of course we aim to as higher as possible, but it's good enough. Okay, means for every percent drawdown we can accept, it's almost 3% growth. So basically it's very good. So this is the idea here, right? And that's how this kind of trading chart looks like. Now let's take a look on another one. That's my favorite. Okay, why? Because first of all, take a look on the gain here, right? 40% profit, but the drawdown is 5%. That's 1 to 8. It's amazing. That's where the traders aim for. Now, what else do I like about such charts? And that's why you have to aim for something like that, because that's what real trading looks like. Okay? In reality, trader not always making money, no, and not always losing money, right? If anyone thinks he can trade without losses completely, wake up, my friend, it's impossible. And if you think it's possible, or someone is promising you, well, I am ready to pay you 1 million. So you really prove That's possible. It's impossible. Exactly, it's like it's impossible to win a professional basketball match between two good teams with one-way score, right? Like 90 versus 0. It's impossible. Okay, it cannot be done. Okay, unless the game is sold, of course. Same on the market. You cannot be on only the winner because you trade against very strong forces. Now, okay, so back to reality. There will be losses, and you have to learn to deal with that. You want it or you don't want it. It's part of trading. Now, why do I like this kind of chart so much? Basically, 80-20 rule, 80-20% rule is in play. Growth, range, growth. What do I mean here? Basically, you see how it starts? Boom, 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 growing up, then boom, range. Boom, 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 growing up and ranging for long periods. Small up, ranging for small periods. Small up, ranging for long period. Boom up, ranging for long period. Boom, and so on. So that's how professional trading look like. On the periods, there will be periods. That's the 80-20%. 80% of the times your trades will break even themselves or keep very small growth. That's the reality. Why? Because the market is not always perfect. The markets can go against. The market can drop into a range that will kill any opportunities. There might be many false breaks and so on. So most of our trading will be just to cover itself, break even. You up, you down, you up, you down, you up, you down. 20% of the time. For some of you it might be 70-30, it might be 60-40 rule. That's alright, that's okay, but most of the time our trading will be ranging. Still growing, but up, down, up, down, up, down, up, down, kind of a range here, okay? The total, we are keeping a wonderful growth, very tiny risk. And how do I know that? Take a look on the drawdown. The drawdown compared to the gain is awesome. So during range periods, profits are not lost, and this is the first rule of a real trader. First of all, learn how not to lose money. And how not to lose money, I don't mean don't lose any trade. Lose trades, know to cover that. Okay, that's the very, very important rule here, and that's what the real traders do. Equity curve follows the growth curve, discipline, strict rules, good money management. That's how real trading looks like. Alright, that's another one. Now you can judge the gain versus the drawdown, not really good. You can see the profits are good, but also boom, the drops are heavy when they happen. Then most of the profits are very, very small. So you can see big loss cloud occur any moment, and it could occur. So versus small losses, you can boom, have heavy drop, and well, there's no logic behind that. That good period could be ruined with only 1-2 losing trade, like in this case. Okay, it's 3 trades and you're down. Bad money management and risk reward lead to such things. Here's another example, not a bad one. 1-to-5 ratio between the gain and the drawdown, even more. It's really, really, really nice. Booms of growth followed by range. That's what I like. Then repeat. Okay, that's slowly but steady growth. Take a look. Boom up, range. Boom up, range. Boom up, long range. Boom up, range even dropping down. Boom up, ranging again. That's the 80-20% rule I was talking about, or 70-30 in your case, 60-40 on some other. That's more than okay, but that's how trading looks like. There will be periods we will be fighting for every trade, but that's where we have to make sure we are around the break even this period, not losing, not gaining. But that's fine, because there will be periods then you will be booming up, making good profits, and great growth. Stop loss seems consistent and equal. You can see the actually the strictly followed strategy here, and the distances are clear here. It's very, very beautiful. Smells like professional trading behind this one. That's where you will want to stick with. Of course, the longer the period of trading, the stronger the performance is. Now, what can we say about that? 44 gain versus 58 drop down. equity spikes, okay, up and down, which means the hopes to take more than the market allows are here. This trader does not really follow strict rules, playing a lot of emotions here, a lot of hopes, a lot of expectations, and maybe prayers. So that's really not good stuff. Trader tends to hold the positions for too long. We can see that equity is growing up, but actually the trade is closed right here, which means the hopes were very, very, very big, the expectations were too big, and well, you plan to take more than the market is ready to give you. That's how it will look like. Perhaps relying on emotions, feeling rumors, speculations, and not following the strategy rule. That's how a chart looks like. That's another one. A lot of trades here, we can see that, right, on a pretty short period, over like a 1.5 year or so in this case. Nothing really bad here except the drawdown. In reality, even not on paper. Take a look, 250 gross versus 58, almost 60% drawdown. Well, it happened after a good growth, so not really that terrible, but it means this trading is risky. Okay, we can see that cutting the profitable trades very early, the dots are too small and close to each other. Huge drawdown spikes. It happened a few times. Boom, 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 boom. This one was big. This one was huge. It happens a few times. There might be a period it will blow all the way down. So that's why such trading could be paying very, very well, but there might be a period that it will drop suddenly, like here, and it will take you down seriously. Okay, and that's basically what inconsistency looks like. That's all. Next one is 38% growth versus 15, almost 16 drawdown. Good periods like that, and will probably happen to you as well. It happens to me. It happens to every professional trader. You have a growth and you have a range. Nothing bad with that, as long as you know on a range, on your not so good period, to stay around break even. Big profits will not be there, big losses will not be there, but there will be range, there will be flat move, and after that ends, boom, you will grow up again. The same 80-20% rule, 70-30, 60-40 for others. That's all the same principle of rule, right? 60%, 70% or 80% of the time we will be ranging, we will be fighting, and our trades will be covering each other around the break even. Then boom, period will take us to up and our account to grow and look very, very, very good. Range that lead to break even are 100% welcome as long as we keep the earnings. Range cycles will end eventually, and profits will come again. First rule of a real trader: do not lose money on a bad period. Learn to stay as safe as possible there. Break even there. You can see that the equity and the growth actually go hand by hand. That's strict strategy. That's a strategy, not just emotional trading. Alright, 20 versus 20. We don't really want to pay attention to that, right? Don't we? Trader lets losses run. It's pretty clear by this chart. You can see the drops on the equity. Okay, drawdown and gain go hand in hand, which is not good for an expected period of 1.5 years here. Just a bit less. You would expect something better here. Such type of trading is suitable only if your balance allows you to hold drawdown and use small or no leverage at all. Okay, with small accounts, you cannot allow yourself to hold positions around. With big amounts, you can allow yourself positions run, of course, as long as your total leverage allows you to do so. That's money management. That's really not the one you will want to follow. So that's basically all. Thank you very much for watching this video. I hope it helped. I hope it opens the eyes a bit. Pay attention for these things, guys, and be clever. Okay, don't just run after anything looks reasonable and growing fast, because whatever grows fast might also drop fast. Remember that the faster it grows, the faster it drops, and the more painful it is. Do not forget to visit my sites and join the most professional trading community. We have VladimirForexSignals.com or my blog VladimirRybakov.com. Thank you very much for watching. I hope it was helpful for you. If you have any question, I'm there for you, and all I can wish you is good professional trading. Join me and let's do it together. Thank you for your time. Yours, Vladimir Rybakov.